Ever wonder how a giant company, say an Apple or a Google, decides where to get billions of dollars for a new project? You might think there's some super complex, secret formula involved. But you know what? The answer is often a surprisingly simple rule. Today, we're going to decode the pecking order of corporate finance and reveal what it's secretly telling us about a company's real confidence.
Okay, let's put you in the driver's seat for a second. Imagine your business is really starting to take off, but you need some cash to fund that growth. What do? Do you dip into your own savings? Do you go ask the bank for a loan? Or do you sell a little piece of the company to some new investors? Well, believe it or not, that's the exact same choice that CFOs of these huge companies face, and their decision almost always follows a very predictable pattern.
For the longest time, finance textbooks were obsessed with finding this perfect, almost magical formula to solve the financing puzzle. But when you look at the real world, it turns out that most managers are following a much simpler, almost instinctual rule of thumb.
Yeah, so the old textbook idea was all about finding this optimal capital structure, this perfect, delicate balance between borrowing money and selling ownership. But the pecking order theory came along and showed us that, actually, managers aren't really hunting for some perfect ratio. Instead, they just follow a very clear hierarchy, a pecking order of choices, from their most favorite to their absolute last resort.
So what is this pecking order? Well, it was developed by Stewart and Nicolas Majluf way back in 1984. And it's a pretty straightforward three-step rule that does a brilliant job of explaining how most companies actually behave when they need cash. And here it is, in all its simplicity. First, companies always prefer to use their own money, the cash they've already earned and saved up. If that well runs dry, then they'll turn to debt, things like bank loans or bonds. And only, and I mean only as a last resort, will they issue new stock, which is really just selling off little pieces of the company. It's not a random choice at all. It's a very clear and consistent preference.
This really just nails the core of the theory. It's not about hitting some target number. It's all about a sequence of choices, and that sequence is driven by some very human factors. So let's break down the logic behind each of these steps.
All right, first up, internal funds. Using the money you already have in the bank is basically the path of least resistance. It's cheap because there are no fees or hoops to jump through, and crucially, it's quiet. You don't have to explain yourself to bankers or justify your plans to the stock market. You're not sending out any signals that could be misinterpreted.
Now, if the company piggy bank is empty, the next stop is debt. And why is that? Well, because borrowing money sends a much safer, cleaner signal to investors than selling off parts of the company. A lender just wants to know if you can pay them back. Plus, and this is a big one, your existing shareholders don't see their ownership stake get watered down.
And that brings us to the final and most dreaded option, issuing new stock. Why is this avoided like the plague? Because for investors, it can look like a massive red flag. The market immediately thinks, wait a second, if the people who run the company are selling new shares, they must think the price is as high as it's going to get. It signals a potential lack of confidence from the very people who know the most about the company. So why does all this signaling matter so much? Well, the entire theory really hinges on one powerful underlying idea, this huge information gap that exists between a company and its investors. And that concept has a name, information asymmetry. It's a bit of a fancy term, but it's a really simple idea. The managers on the inside know the real story. They know the true value, the secret projects in the pipeline, the real future potential. But outside investors, we're just on the outside looking in, trying to piece it all together from public reports. That gap is what drives this whole pecking order. Think about it from the manager's perspective. If a manager truly believes their company's stock is undervalued, that it's a total bargain, the absolute last thing they're going to want to do is sell new shares at that low price, right? It would be like giving away a valuable asset for pennies on the dollar to new owners. And here's the other side of that exact same coin. An investor sees a company issuing new stock, and their first thought is, whoa, hold on, the insiders must think the stock price has peaked. They're trying to cash in while it's hot. This reaction can actually cause the stock price to drop, which proves the manager's initial fear totally correct. It becomes this nasty, self-fulfilling prophecy. So this isn't just some abstract theory from a textbook. Let's take a look at how the pecking order actually plays out in the real world, because it leads to some really fascinating and sometimes kind of counterintuitive results. And here's what I think is the great paradox of this whole theory. You'd think that the most profitable, successful companies would be loaded up with debt to fuel all their amazing growth. But a lot of the time, the exact opposite is true. Because they generate so much cash all on their own, they almost never have to move down the pecking order to borrowing money. Their own success means they often have the least amount of debt.
And you can see this play out really differently across various industries. Just look at this comparison here. Tech firms, right? They often have pretty uncertain cash flows, and most of their assets are intangible, like code or intellectual property, so they tend to rely super heavily on internal funds. But then you look at manufacturing firms. With their stable income and big physical factories they can use as collateral, they're much more comfortable moving to step 2 and taking on debt when they need it.
So what's the big picture here? What's the final takeaway? I think it's really important to see the pecking order theory not as some strict, rigid rulebook, but more as a powerful lens for understanding why companies behave the way they do. Of course, it's not perfect. No theory is. It doesn't fully explain situations where managers might act in their own self-interest, or when they might issue stock just because the market is really hot and they can get a great price. And, it kind of assumes a company always has internal funds to start with, which just isn't the case for a lot of new or struggling businesses.
But the really crucial point, the one thing to take away from all this, is that a company's financing decision is not just a math problem on a spreadsheet. It's a form of communication. Every single choice sends a powerful signal to the market about what the management truly believes is coming next for the company.
And that leaves us with our pretty interesting question for the next time you're looking at a company. If you see them funding some huge new project without selling a single new share of stock, are you witnessing the ultimate sign of confidence? Is that the management team quietly telling the world that they know for sure that they're sitting on a gold mine? Something to think about.